Let's dive right in. Imagine you've got $100,000 ready to invest in financial ETFs. Now, the big question is, what is the one single portfolio that gives you the best possible return for the least amount of risk? Today, we're going to build it step by step.
See, the real key here isn't just about chasing the biggest gains possible, and it's definitely not about playing it so safe that you don't grow your money. No, we're on the hunt for that perfect sweet spot, the truly optimal balance between risk and reward. And by the end of this, you're going to know exactly what that portfolio looks like. All right, before we go any further, the usual fine print. Just a quick reminder, this is all for educational purposes. It is not financial advice, and you should know that all the scenarios we're about to walk through are hypothetical.
So here's our game plan for today. We'll start by framing the question like a pro. Then, we'll introduce the 4 key ingredients we'll be working with. After that, we'll put 3 competing strategies head-to-head, run them through a brutal stress test, reveal the final winner, and then wrap it all up with a simple blueprint you can use to execute the strategy.
Okay, so first things first. If we want to find the optimal answer, we have to start by asking the right question. And that means we need a pretty big shift in how we think about investing in the first place. This is where most investors get tripped up. They're stuck on the left side, asking which single ETF is going to be the home run. But that's not how the pros think. They focus on the right side. How do all my different assets play together? Because here's the secret. Your real performance doesn't come from one amazing pick. It comes from how the entire team of assets work together to handle risk. So, with that in mind, let's meet the building blocks we're going to be using. We've picked out 4 very specific financial sector ETFs, and you'll see that each one has a really distinct job to do. Think of this like you're a general manager building a sports team. XLF, that's your star defensive player. It's your anchor. It's super stable, has giants like Berkshire Hathaway, and it's incredibly cheap. VFH is a great complementary player. It adds some depth by bringing in mid and small cap financials. And then you've got KRE and KBE. These are your strikers, your offensive powerhouses. They're really sensitive to things like interest rates, and they can seriously amplify your growth, but they also come with a lot more risk.
Now, to really get how these pieces are supposed to fit together, we've got to talk about one key idea, and that's correlation. Don't worry, it's simple. It's just a score from 0 to 1 that tells us how much 2 different assets move in the same direction. A perfect 1.0 means they're basically identical twins moving in perfect lockstep.
Okay, and this is where it all clicks. Look at the correlation between our 2 defensive players, XLF and VFH. It's 0.97. They're almost the same thing, so owning both of them doesn't really give you much diversification. But now, look at the pair on the right, our defender, XLF, and our striker, KRE. The correlation drops all the way down to 0.85. Now that might not sound like a huge drop, but in portfolio terms, it's a game changer. That difference is where you get real diversification. It smooths out the ride. That's the secret sauce.
All right, we've got our ingredients. We understand how they work together. So we've built 3 totally distinct strategies. You can think of them as 3 different paths up the same mountain. Each one has its own level of risk and its own potential reward.
And here they are, laid out side by side. The conservative portfolio is almost all in on those stable core holdings, 95%. The mid-growth starts to dial up the risk, mixing in a 30% tactical position. And then you've got the aggressive portfolio, which flips the script entirely, betting a massive 65% on those high-risk, high-reward tactical ETFs. And just look at the estimated max drawdown. It tells you everything you need to know about the risk you're taking with each one.
First up, the conservative portfolio. I mean, you can see it right there. It's completely dominated by that defensive core of XLF and VFH. We've only sprinkled in a tiny 5% tactical allocation to KRE. Think of that as just a little spice, a way to maybe catch some upside if the banking cycle turns, but without really taking on any serious risk. The name of the game here is stability. Next, we get to the mid-growth portfolio. You can see the shift immediately. That defensive core is down to 70%, and now we've got a pretty significant 30% chunk dedicated to our tactical players, KLRE and KBE. This is for someone who's a bit more confident, someone who wants to take a position on the economy and really capture more of that potential upside.
And finally, the aggressive portfolio. Let's be really clear here. This isn't just a diversified portfolio anymore. This is a big, concentrated bet. With a whopping 65% in those regional and money center bank ETFs, you're not just investing, you are betting hard on a strong banking cycle and a steep yield curve. The upside? Potentially huge, but the risks are just as big.
So we have our 3 contenders. Now for the main event. It's time to put these portfolios through the ringer. We're going to simulate some real-world financial crises to see how they actually hold up when things get really, really ugly.
But before we look at the results, let's just pause and remember this simple, absolutely brutal piece of math. If your portfolio gets cut in half, a 50% loss, you don't just need a 50% gain to recover. You need a 100% gain just to get back to where you started. That's why managing your losses is, without a doubt, the most important part of investing for the long haul.
And wow, this chart just illustrates that point perfectly. Look what happens in a banking crisis like the SVB collapse. The conservative portfolio barely even flinches. Meanwhile, the aggressive one gets absolutely crushed. Same story in a deep recession like 2008. The conservative portfolio holds up the best by far. In fact, the only time the aggressive portfolio wins is in a crazy, extreme, rip-roaring bull market. In every other likely scenario, defense wins the championship.
Okay, the stress test has pretty much settled it. We have a clear winner when it comes to survival. So now it's finally time to answer that big question we asked at the very beginning.
After all of that analysis, all of the testing, the single optimal portfolio is the conservative one. Now, I know it might not be the most exciting choice, but the data here is just crystal clear. It gives you the absolute best balance of risk and reward across the widest range of things that could happen in the future.
So why does it win? Well, it's actually pretty simple. As we just saw, it performs the best when things go really wrong. But here's the kicker. It also tends to win in the most likely, normal market scenarios, mostly because it has lower costs and is just more resilient. You don't have to be a genius or time the market perfectly, and most importantly of all, it maximizes your chance of survival. And that is the real secret to building wealth over the long term.
So we have our answer, but knowing the answer isn't enough. How do you actually put this into action with your $100,000? Let's quickly walk through a super simple, actionable blueprint.
It really just boils down to 3 steps. First, figure out your entry. You can go all in at once with a lump sum, or you can ease in over a few months using dollar-cost averaging. Second, rebalancing. Just check in on your portfolio twice a year, and if things have drifted, gently nudge them back to their original targets. And third, and I can't stress this enough, this is the most important part, discipline. You have to stick to the plan. You have to avoid making emotional decisions when the market is going crazy.
And that brings us to our final thought for today. You know, we're all trained to chase the biggest, flashiest returns. But as we've seen, that's just the wrong way to look at it. The best portfolio isn't the one that makes the most money in a great year. It's the one that survives the worst years. Because in the end, survival, that's what creates real lasting wealth.